Hello, everyone, and thank you so much for joining us for our quarterly investment commentary webinar. I'm Margaret Sargent, Senior Marketing Associate here at New Frontier, and I am so pleased to be joined today by our President and CEO, Dr. Richard Michaud, CIO, Robert Michaud, and Research Analyst, Joy Zhang. Today's webinar is going to begin with Robert, who will provide an overview of New Frontier's investment philosophy and process, as well as a look at the recent rebalancing of our 15 global multi-asset ETF portfolios. Joy will then review the quarterly performance of both the New Frontier portfolios and, more broadly, the global market. She will then pass things over to Dr. Michaud for a discussion of the key points from his quarterly market commentary, and we will have some time for Q&A at the end, as well as a few updates from marketing. Just a quick housekeeping note before we begin. Your lines will be muted for the duration of the call to reduce background noise. So if you do have any questions, please submit those using the chat feature of GoToWebinar. And without further ado, I will pass things over to Robert.
All right, thank you, Margaret. So investment process, that's where we like to start, where we like to talk about. Investment process is always important, but during times like these, it's especially important. You need to have something to fall back on, something that's reliable, something that you can understand really well, and to take the guesswork and the emotions and bring investments into some sort of rational scientific methodology. So what do we need to do? We need to build portfolios for 3 different investment objectives, 6 different risk targets. We target the stock-bond ratio as a transparent way to show what the risk of the portfolio is. I think it's quite important right now to have a great deal of transparency when volatility is as high as it is, to still know that you have a consistent exposure to the market, and make sure that your client is comfortable with that. So how do we do it? Well, the investment process we think about as sort of 4 main steps. Each step you can think about, you need to pick your asset classes for a good reason, exposure to risk premia, low correlation, want a sophisticated way of thinking about estimating risk and return, construct your portfolio, and then monitor it. So this is easy, right? So all you need to do is all of those things, and you put it into an optimizer, and your optimizer will maximize return, minimize risk, and do a lot better than a naive combination of stocks and bonds. And it will give you the appropriate portfolio for all of these different investment objectives. But this is not a normal time. This is a time where risk and return don't behave as they had over a normal market period. And I just wanted to show you a little bit of our empirical research into what return and volatility look like during a normal period. Normally the VIX is under 20. Right now it's in the 40s. It had gotten up into the over 80, which is the highest it has ever been. And during these time periods, volatility is very persistent. So if it's volatile right now, it's likely to continue to be volatile for some time. It doesn't say a whole lot more about returns, but actually something that is mildly reassuring is that what we have found is that in the past, on average, during times when there's a great deal of market uncertainty and volatility, that future returns tend to be a little bit higher. So this means that there's no free lunch. It's not a particularly good time to invest because there's a lot of risk there, but it is not a obvious time to exit the markets either, because you'd be giving up a great deal of return on average should you exit the market whenever it gets volatile. So how do we invest during this time period? I think we can fall back on some of our strengths. We were here for 15 years. We were including the financial crisis. This is the longest anyone has been doing ETF investing anywhere. We have the world's leaders in optimization process to help us build the portfolios. And in particular, our optimization is really designed to solve the problem of how do you build a diversified portfolio under uncertainty. And then we can do this through ETFs. We're an independent manager, so we can pick the ETFs that we think are most appropriate for all of our clients. And we have a fair amount of flexibility to be able to adapt to market environments. So what is our solution? I think we need a really dynamic estimate of risk and return. We need to optimize the portfolios under highly uncertain conditions. And figuring out how to rebalance during a time like this is also quite a challenge, and all the while following our process. So it should be easy, right? Just tell me the risk and the return, and we can solve the mean variance optimal problem for you. Just a little problem, does anyone actually know the risk and the return right now? We know that the risk is higher, and that's about all anyone really knows. So follow our process, and our process will be to try to estimate what the risk and return relationships are right now, model the way markets are working now, not the way they have been working in the past, and then to model this over thousands of future scenarios, given that we definitely do not know exactly how future risk and return are going to play out, optimize these portfolios and come up with a very well diversified solution. I think right now it's incredibly important to have a well-diversified portfolio. We don't want a lot of exposure to any one risk factor, certainly not any one stock or sector of the economy. I think geographical diversification is even more important now than it is during normal times, because we do not know how this pandemic is going to play out. So we have our optimizer, and it has some reasons to think it can help. Markowitz has tested it. It clearly gives more diversified portfolios. And the nice thing about more diversified portfolios that we have shown through our research is it has more certain outcomes. That doesn't mean anything certain right now, but it's more certain than if you're taking a big bet on one specific risk factor or one specific outcome of portfolios. So then the last problem is rebalancing. Right now, we have recently rebalanced our portfolios about a month ago, but for the last 2 months, things have been quite different. And normally what you would do is you'd think about an optimal portfolio. Your portfolio is right on the efficient frontier. And then after a while, price changes may pull the portfolio off of the frontier from just normal price movements. And then of course, new information is going to arrive. And so this happens under normal conditions to some extent, but over the recent periods, this has happened a great deal. And so we had an enormous need to trade to rebalance our portfolios, because both prices have moved and the portfolio was in a very different set of weights than it started. But even more meaningfully, the whole world had changed, and it was very important to be able to adapt to that, to the market environment that we're in. And so then when we rebalanced last month, we needed a combination of both of these things. So we were clearly outside of this statistically significant region and need to rebalance our portfolio. So that's the nice image for what we did. What are the some of the actual implications, and how did the portfolios change? Here's a short table that I don't want to go into too much detail, but certainly there were major changes to the yield curve, major changes to credit spreads, the risk of China compared to the rest of the world. And on the tax sensitive side, municipal bonds were exhibiting much more exposure to risk than they did normally. And so all of these things had to be, and of course yields were much higher in the multi-asset income portfolio. So all these things needed to be compensated for and adapted to when we rebalanced our portfolios. So I think with that, I do want to turn it over to Joy, and she will tell us how our portfolios have performed.
Thank you, Robert, for the summary of our investment process. Now let's move on to performance. We always start the performance with a review of our indices, as they are the most transparent representatives of our investment process, provided in real time. The index returns are calculated and verified by S&P. What we have here are 6 risk-targeted indices, ranging from the most conservative 2080 NFGII to the most aggressive All Equity Index NFGEI. And looking at the chart, we have dark blue and light blue bar here indicating our index and blended benchmarks performance for the last quarter. Green and yellow bar are for 1-year performance. So one quick observation from the chart is that the last quarter's performance by these blue bars actually dominates the 1-year performance. And the last quarter swept up gains that gains were from the first 3 quarters and jacked the 1-year performance into negative territory. On the relative basis, our indices have outperformed the benchmarks on both time periods, especially on the less aggressive side. It's really good to have a positive number here when everything goes negative. And this outperformance range from 2% to 4% on 1-year basis. It's important to remember that our investment process, as Robert mentioned, does not simply blend in same stocks and same bonds for different ratios to create different profiles, but each index is optimized with different investment objectives in mind. So each one is different with different bonds and stocks. As a result, contributions are different. For example, conservative index here not only benefited from having more bonds, but also having more or less risky equities, like US low volatility, that has done relatively well in the last quarter compared to risky equities. And balanced index, on the other hand, benefited from high duration exposure, like long treasuries in the portfolio, which is doing exactly what it's expected to do, hedging equity risk in the portfolio. So let's move on to tax sensitive. Here is net fee performance for our tax sensitive strategies. Again, we have the performance for the last quarter and performance on a 1-year basis. Tax sensitive portfolios have performed largely in line with standard portfolios, with slight underperformance on pre-tax basis, but this underperformance almost gone when tax is considered. Muni bonds have slightly underperformed treasuries, which explained part of the underperformance. We will talk more about muni when we cover asset returns. Now is our multi-asset income portfolios. Again, blue bars are for quarterly performance, and green and yellow are for 1-year performance. Normally, as interest rates go down, we would expect dividend stock to do well, but not this quarter, as there are growing worries over corporates' profits and companies' ability to pay out dividend. High dividend stock suffered in this time period. And basically anything that promised yields hurt in the last quarter due to the uncertainty of cash flow and payout. But on the other hand, our multi-asset income portfolios have outperformed their benchmarks, especially on the aggressive side, as we can see from the chart, thanks to its overweight in emerging dividends and high quality US dividends. And right now, dividend yields for these 3 portfolios are ranging at 5% range. So that is our index and strategy performance. Now let's take a look at assets that we're currently investing. First, on the equity side. And looking at the chart, blue bar are the last quarter's performance and green bar for 1-year performance. We can see gold stands out from the chart with more than 20% 1-year return. And allocation to gold really helped to provide protection in this time period. Also want to mention China, as China is another good example here to show benefits of global diversification. We all know that China historically is more volatile, but during this time period, when risk factors like size and value were hit most, China, on the other hand, outperformed the rest of the world and helped to mitigate the scale of decline to the portfolio. And moving on to fixed income side. I have to say it is a wild quarter for bonds. It comes no surprise that US Treasuries were great, with long treasuries being the best performing asset in the last quarter. International treasuries here didn't do as well as long treasuries, and things were even worse for emerging market debt, as emerging market sovereign creditworthiness were being questioned during this time period due to coronavirus outbreak, as well as sharp fall in oil price. Similar stories goes for corporate debt and corporate credit. High yield lost 13% in the last quarter due to the elevated default risk. And one more thing I want to mention about risky bonds. We all know that risky bonds didn't do well in the last quarter, but they had actually performed really bad in a few days. Example like investment grade corporate. They actually have suffered even more than high yield during the third week of March, given concerns of massive downgrade of BBB rated bonds. But they bounced back later. So the overall risk for the last quarter was not that bad. And let me show you another example for Muni. As we all know, price goes down, yield goes up. Muni yields compared to treasuries surged in mid-March to the historical level. And after Fed decided to step in and to steady the Muni market, it has gradually calmed down. Right now it's still elevated, but it's closer to the normal range. So right now you may wonder why we're looking at 2019 performance of S&P 500 loan treasuries. Some people may be familiar with this, as this is the slide I used in the fourth quarter of 2019 when I was talking about how we have been thinking of loan treasuries in our portfolios as a equity hedging vehicle to provide diversification and also for risk management purpose. Back then, we were not predicting that interest rates will go down, but last quarter turns out to be one of the good examples to show that benefits loan treasuries have brought into the portfolio. As we all know, loan treasuries, as I mentioned in the asset performance, is the best performing asset in the last quarter, and stocks didn't do well in the last quarter. So it comes no surprise that the negative correlation between those two even goes even more negative. And again, this proves to be beneficial to our portfolio as we stay diversified. Given the current uncertainty, no one knows for sure how long this will last. But the best and the most important thing we can do is to stay diversified. And with that, I'm going to pass over to Dick for market perspectives.
Thank you, Joy, for the performance review. And now it's my turn to talk about our market perspectives. So we have a commentary each quarter, and I will be reviewing that. I call the instrument flight rules because it's definitely not clear flying in this market currently. It's been a crazy time, and we all have to find some way of living through it. So on January 1st, China informed the American government of a new pathogen, the COVID-19 or coronavirus that had been discovered in Wuhan, China. Its toxicity and infection rates were unknown at the time, and there was no medical cure. So epidemiologists warned that a global pandemic could result. The contagion in China soon traveled to the rest of the world, first South Korea, and then Italy, and then the rest of the world, really. Its toxicity and virulence proved very severe, with grievous loss of life. The world was plunged into a very dark place that remains totally unresolved at this point in time. So the virus dilemma. Virus poses a very serious political dilemma. Protect human lives or save jobs and the economy. So early stage containment and social distancing policies are the only methods currently known for controlling the course of the epidemic. It's been used before in other previous epidemics, but unless there's a vaccine or unless there's some medicine that somebody invents, it's the only method for controlling the course of the epidemic. And the mathematics of an epidemic is well known and very unforgiving. Infection rates compound when unchecked. That's really the serious problem with an epidemic. Even 2 or 3 days of delays of, say, containment can result in hundreds of lives lost. So the coronavirus was like nothing in anyone's experience. Few understood the potential severity of the pandemic, especially at the beginning. And politicians and media and the public understandably wanted to ignore the threat to life while maintaining a semblance of normality and jobs, as we all want to do right now. As of late, mid-February 2020, it's kind of interesting to look back. Wall Street was very complacent. The S&P 500 had risen almost 5% since the beginning of the year. The 11-year bull market showed no sign of ending. Excuse me. And volatility was low. The economy was strong. And treasury rates were at historic lows. The Fed was on a glide path through the election. They weren't planning on raising or reducing the Fed funds rate. Unemployment was extremely low. Inflation was stable. Impeachment trial had been over, and the primaries were ending. Mid-February. The Dow reached a historic high on February 12th, and then from that on, things changed. The notion of a global pandemic awakened into public consciousness from mid-February on. Wall Street stocks took just 16 trading days to tumble 20%, the fastest into a bear market in financial history. The extreme market volatility persisted through the end of the quarter. We had 11 trading halts in 10 days. The S&P quarter ended up 20% down, the worst first quarter in history, nearly the worst since the Great Depression. The VIX was reaching 80%, and the equity was down 22%. Fixed income was mixed, though. The U.S. Treasuries were, of course, the haven asset of choice for global investors, and the 20-plus year Treasury bond iShares ETF was up 22%. It was virtually the most important, the most significantly positive asset ever during this period. But the Barclays Corporate Index was down 3.6%, and it clearly was a mixed world. Okay. So by March 31, political reality had set in the United States. The president had acknowledged authoritative projections of 100,000 to 240,000 deaths in the U.S. from the virus pandemic, the most forecast deaths of the virus from any country. And daily deaths are forecast to peak right about now for all of us here. So many parts of the country was highly unprepared for medical resources, personnel needed to care for a tsunami of infected patients. The most optimistic projections assumed, and that's, I think, very important for people here to remember, that countrywide rigid social distancing policies would apply through May. And that is not happening right now. Most, if not all, states had a social distancing policy in place at the end of the quarter, but high levels of deaths were projected well into the fall, even with rigid social distancing policies. Social distancing policies have major implications. Mandating social distancing necessary to limit the pandemic when no cure is available is a politically fraught decision for any politician. It necessitates a virtual shutdown of the economy. Only essential firms and workers are allowed to function, so it has a tremendous impact on the economy and all the people in the economy. 10 million Americans filed for unemployment insurance by the end of March, and with many, many millions to follow now. It's not just like 2008-9 anymore, where the economy is slowing dramatically and fearfully, okay? So on the 15th, the Federal Reserve went all in with emergency monetary policies, a very thoughtful thing to do. They tried to stop the job losses that occurred in the Great Recession. This is what they were trying to do with this all-in policy. So on Sunday night, they announced the Fed funds rate is reduced overnight by 1% to 0. Okay, they're going to buy as much government-backed debt as needed to restore normal market functioning in housing, and in treasury bonds. They are also going to buy longer dated corporate debt for the first time in history. They had 2 new programs to provide bridge financing for investment grade companies and purchase already issued debt that has become hard to trade. The lender of last resort, including bond ETFs, which surprised many. And then they resurrected a loan facility for small and medium-sized businesses. This was Sunday night. And for their pains, the very next day, Monday, the Dow dropped 13%, the worst point loss in its history. Clearly, monetary policy, even at this level of heroic level, was not enough. So by the end of the quarter, the pandemic was no longer being ignored by the Washington politicians. It takes a lot for some politicians to pay attention. Anyway, there was a bipartisan effort for a $2.2 trillion fiscal stimulus program. It's called the Coronavirus Aid, Relief, and Economic Security Act, CARES. And it was by far the largest fiscal stimulus program in human history. $500 billion directed to the Fed emergency lending program. And because of the way it's being used here, it can be leveraged, according to good economists, up to 6 times of the $500 billion amount. They provided disbursements of small amounts to individuals. We all know about that. Unemployment benefits were expanded. And we have this wonderful $350 billion loans to small businesses, the PPP program, which is a little bit of an embarrassment, I think. And then $500 billion in bailout money to large companies with restrictions on how the businesses can use the money, which was quite an interesting thing that happened there. So just to recap all of this, okay, I think this quote from the Washington Post is pretty useful by the Representative Raskin at Maryland. So everybody understands that this CARES is an absolute desperation measure for the whole country. We have tens of millions of people being thrown out of work. The hospitals are stressed to the point of collapse. The states and cities are completely overburdened and near collapse. Public health systems are about to break. And so, you know, as he says, there's really no choice. So as a footnote, a new stimulus package was already in discussion shortly after that was passed. And right now, today, the Senate announced that they think they have a deal to go to the floor of the Senate for a new stimulus package. Now, I'd like to think that this is useful here. A financial historical perspective. Now, the pandemic has dire consequences for economic growth, as we all know, and financial wealth, and of course, for the lives lost and the social consequences to the health of the American people. But it is not a repeat of the Great Depression. America has far more wealth than it did in the 1930s. Its financial and economic institutions are far better structured. The country remains one of the elite, technologically sophisticated countries in the world. In many parts of the economy, if they are shut down, many others are operating virtually via the internet and video conferencing, and that is what's going on with New Frontier. We are operating not quite normally, but through the internet. Very simply, my message is 2020 is not 1930. So we're talking about unforecastable risk, okay? No one predicted the emergence of a coronavirus in China or its impact on the global economy or on capital markets. The virus is an exogenous risk, not part of any quant model for investing, not part of any economic model for managing an economy, not part of any valuation framework for securities. Now, exogenous events occur, okay? Floods, hurricanes, earthquakes, and volcanoes are examples of unforecastable risks that can have terrible consequences to financial markets. But I think it's important to pay some attention to this, that unforecastable risk is also an everyday part of our lives, because each moment in time is different and not repeatable. There's no guarantee when I drive to work I will arrive in the office. Routine makes the world seem predictable, but it is not predictable. Thinking in terms of finance, now how to accurately forecast the success of a business project or a stock? Cost. How do I forecast the cost at time of launch of those business project? Time to market, the competition at that time, whether consumer sentiment has changed or not. True economic risk is essentially deeply unforecastable. So now let's think about where we are. The Dow dropped from a high of 29,550. That's the good old days at this point to, on February 12th, to a low of 18,600 on March 13th. So given market, economic, and political uncertainty on the 13th, how would you advise an investor or a friend in this enormous downturn, thinking about it from the point of view of March 13th? Well, there are three common reactions, right? The first reaction is, let me cash out. I can't take it anymore, okay? The other is, stay the course, stay the course. You've heard many managers talk about that. And then we like to talk about rebalance to optimal. Each one of these reactions is perfectly rational response to market uncertainty that we have experienced recently. So cash out. The key principle in a well-defined investment program is that investing has to do with setting aside savings for future needs. So losses should not disrupt an investor's planning for current needs, that's for sure. Understandably, of course, in a major downturn of this kind, which is a major downturn, substantial financial losses are an emotional issue for many people. So on the 13th, people might have been very, very interested in wondering about whether they should cash out. So managers often offer the mantra, don't panic, but they cannot guarantee. The risk of further loss may have life-changing implications, and they can't guarantee there won't be further losses. So cashing out may make perfect rational sense for at least some kind of investors. Some investors include those with a limited investment horizon due to age or health, especially in a pandemic. Now, stay the course is what investment managers often advise clients. They don't want you to cash out. They advise you that panic selling may be ill-advised. They might quote some theorists that say the market is stable with long-term risk, and markets may reverse with and reward a little bit of patience. Well, they weren't wrong here. The Dow has been up 24,000 since the March 13th low of 18,000. Okay. But managers have a veteran, so another thing to worry about in this stay the course thing is that managers have a vested interest in telling investors to stay the course. For business reasons, they prefer you don't take your money out of their funds. But there is no guarantee losses could not continue to grow. And so we really need to think in terms of how people are feeling as human beings. And in addition, after downturns, many portfolios are unlikely risk-return efficient. So persistent losses could easily result from a portfolio that you stay the course with, because these portfolios are almost certainly very highly risk-return inefficient. So staying the course has additional issues for anyone having a portfolio, not just a single index portfolio or just a single index investment. So rebalancing to efficiency in a downturn is often even necessary. So our solution here is in major market downturns, prior market efficient risk structure is slightly distributed, and the drifted portfolios are very likely to be far from efficiency. So I think the generally desirable option is to rebalance to a new risk return efficiency. That advice is independent of whether the future direction of the market is up or down. It's independent of what should happen. You want your portfolio to be well positioned for weathering any future risks. Of course, there is a problem with rebalancing. How do you define portfolio optimality? Well, market is the framework of choice, the theory of choice for defining portfolio optimality, but delivering a currently optimal portfolio is really no simple task. Creating a risk-return optimal portfolio requires a lot of data management, a lot of investment experience. It should require lots of significant portfolio optimization technology and tools for monitoring and rebalancing the portfolio. So in general, the investor recourse is to find a professional manager that can provide appropriately rebalanced optimal portfolios for investments. The two kinds of professional asset allocation strategies are target date and target risk. Okay. Target date funds use a glide path to reduce systematic risk, and usually defined by the stock bond ratio, as an investor approaches retirement age. Okay. Target risk funds are very different. They provide investors with a spectrum of systematic risk levels for meeting long-term objectives. Now, in a major unforecastable risk environment, a target date fund has no option for rebalancing to optimality. People don't recognize that and don't pay attention to this. You have to wait until your retirement to rebalance this portfolio. Of course, you can always just decide not to invest in it and you can cash out. But in terms of its optimality with respect to current market conditions, it probably has very poor optimality. In contrast, target risk funds can be appropriately rebalanced to optimality. Each rebalanced systematic risk level portfolio remains appropriate for meeting long-term objectives. You've been rebalanced to optimality. You can still stay with the 60-40 portfolio or the 75-25 portfolio, or whatever portfolio was the right thing to use and meeting long-term objectives. And also, what it does is does something really unique and interesting. Investors could slide up and down the frontier of target risk efficient portfolio to reflect changes in their perceptions of economic risk or in terms of their own habitats. So New Frontier rebalanced all, Robert was talking about it, all target risk portfolios by the end of March. Rebalancing was motivated not because we just wanted to do that, because it was motivated by our patented portfolio monitoring technology. And of course, the rebalance reflected many changes in data and relationships and many other things. And of course, it's all together totally independent of retirement age. It has nothing to do with retirement age. So rebalancing was locked in fixed income gains, and we tried to use the proceeds to buy cheap securities, which turns out to have been not such a bad thing to do from many point of view. Okay. So before I end this presentation, I just want to make what I think is a very serious research announcement. I think maybe this will be the signature research announcement of the firm. And it definitely is right up there with our invention of the Michaud Efficient Frontier and also for our estimation era research. The April 16th webinar presentation of New Frontiers is Quant Fundamentally Flawed paper was sponsored jointly by the CFA Society here in Boston. We are very appreciative for their support. And many societies of the CFA societies were also tuning in. It was pretty much not only nationally broadcast, but it was also, even to some extent, internationally broadcast presentation. It will be a forthcoming paper in the Journal of Investing shortly. The reporting will be soon available on a YouTube video for all of you to see. And right now there is a preprint on SSRN and ResearchGate and of course on our website. And so I want to read the following summary just for you to understand the significance of this new paper, because I think it is really an important paper for the last 50 years of finance. We present important new research on the likely limitations of a number of popular active institutional quantitative investment strategies. For nearly 30 years, textbooks, formal university courses, journal articles, conferences of all kinds, and institutional marketing have touted the claims of applications of the Grinnell fundamental law theory that may add investment value to optimized or quantitative investment strategies, even when only a small level of information is available. What we show in this paper is that many popular strategies, things you hear in many different kinds of presentations, which are associated with, and many of them are associated with Grinnell theory, are likely unreliable and self-defeating. This is because estimation error, ratio 89, and constraints required in practical application were ignored in the Grinnell theory. We showed that, and this is our conclusion, far more information than commonly assumed in the Grinnell theory, and very importantly, appropriate portfolio structure are likely necessary for outperformance in practice. So at this point in time, I'll turn it over to Margaret Sargent and Q&A.
Great, thank you, Dick. So I am going to take us through a couple of notes from the marketing team, and then if you do have questions, you can take this time to send those in. So first, I just want to highlight 2 recent media pieces and 1 event. Earlier this month, Robert sat down with Money Life host Chuck Jaffe to offer some insight on how New Frontier approaches portfolio optimality in a time of tremendous uncertainty in the market. And that recording is available on our website as well as on Frontier Advisor. And last month, ETF.com featured an article by Robert that discusses how the ETF investing landscape has evolved over our 15 years as an ETF strategist, and what our investment committee has learned in that time. So you can find the links to those 2 pieces and others on the media coverage page of our website. And finally, as Dr. Michaud just mentioned, he and our Managing Director of Research, Dr. David Esch, just last week presented their paper, Is Quant Fundamentally Flawed?, which is forthcoming in the Journal of Investing. And as was mentioned, the lecture was presented by the CFA Society Boston, and we had nearly 400 people join us for the live webinar. So given the level of interest, we will be making a recording available very soon. So if you were unable to join us and are interested in watching that presentation, please keep an eye out for that. These folks are the wealth management team that is focused on supporting you and your practice. David Schubach and Nick Lamb in the Eastern Division, and Jesse Andrews and Keller Schluter in the Western Division are here to answer any questions and provide resources and materials. And I know that they are all looking forward to being able to meet with all of you in person again. Our 6 global ETF indices are all available through the S&P website, through Yahoo Finance, Bloomberg, or wherever you typically seek out your index data, including on smartphones and other devices where you can track the indices in real time. As always, we encourage you to take advantage of our advisor portal, Frontier Advisor, where we recently added a new Navigating Volatility section. This houses a collection of resources, both written and recorded, that all address the heightened volatility that we have seen caused by the COVID-19 pandemic. And also on Frontier Advisor, you can, of course, run custom proposals for your clients, which contain both detailed portfolio analytics and comprehensive educational materials that you can share with your client. So with that, we can revisit if we have any questions. We have, what is your short-term and long-term outlook for high-yield corporate bonds?
We do not really focus on any one asset class or and asset classes individually, but instead what we try to look at is the relationship amongst asset classes on risk and return. And so right now there's obviously a tremendous amount of volatility. And I just want to make a point about volatility, right? The VIX hit 80. When volatility gets this high, it doesn't just mean that prices are moving around a lot. It means that there's fundamental uncertainty about how the world's going to evolve. That means that there's questions of certain asset classes remaining viable and which parts of the global economy are going to really survive through everything. So this is a very high level of risk. So this relates to corporate bonds and all types of bonds, in that they saw a great deal of uncertainty and fear about their ability to pay back their coupons. And So we saw one of the things that I really liked that Joy showed us is that there was this huge increase in risky bonds credit spreads for corporate bonds, the high yield, high grade corporate bonds, which you normally don't expect to react that strongly, and relatively high grade municipal bonds are another one. So, but then they came back a lot. How does it all fit together? In terms of how it fits together, a well-diversified portfolio still has some place for corporate bonds. The very high spreads, credit spreads that we see, I think are, you don't want to be backward looking and assume that all the bonds will continue to pay their dividends and no investment grade bonds will be downgraded. And so I think you need to both look beyond history and say that these are much riskier, but there is some possibility that they will at least have a somewhat higher return than treasuries going forward. But so I think we have for credit risk, we had a very cautious slight increase in credit risk across our portfolios for that reason.
Great, thank you, Robert. The next question we have is there a big concern about multiple bankruptcies among a broad range of industries?
This is where do you go? What do you do as an investor? And I think being very well diversified is the only reliable solution during a time like this. And so I think there's industries, sectors, asset classes, geographical regions. You want to be careful having any sort of specialized fund that has a really targeted exposure. If you have to be a little bit more careful about dividend funds or high yield funds and certainly sector funds than you did in the past. When I think about risk, I often go back to thinking about one of the lowest volatility portfolios of all time was a Japanese utility portfolio. And then an earthquake hit in Fukushima. And so this portfolio that no one had ever seen any volatility in before suddenly, almost literally, unfortunately, blew up. This is the importance of diversification, to be able to be protected to some degree from the unforecastable risks that we encounter.
And just to add to that, the effective diversification is the single most reliable. It's in fact the only really reliable risk management tool for downside risk. And so what we try to do is do the risk management with our unique technology, and we rebalance these portfolios after we've learned that the portfolios are no longer optimal. And we don't just do that on a calendar basis or an individual security basis, but at the portfolio basis. So one of the most important things we do has to do with a portfolio rebalancing technology, monitoring all of the portfolios on a daily basis, and then making judgments of when the portfolios are significantly out of sync. When we rebalance. And that's what we did at the end of the quarter here. The end of the quarter was a really stressful time to be making rebalancing decisions, but we followed our process and we thought that was the right thing to do for our clients and for our investors. And I think it worked out really quite well. And we didn't shrink from doing what we needed to do in that really volatile week that we had to make decisions on it. But that's what we're trying to do. The target risk funds are presumably always optimal in some fundamental sense. And when at any time the portfolios become less optimal, significantly so, we rebalance to optimality. So your 60-40 portfolio should presumably always be the best solution for you for meeting long-term objectives if a 60-40 level of systematic risk is the appropriate thing for you.
Great, thank you. It looks like that is all of the questions that we have in. If you do have any questions that you didn't get to submit, please feel free to reach out to us. Thank you so much to our three panelists, and thank you to everyone for joining us today. Have a great rest of your day, and we will see you on the next webinar.
Thank you.